Quick message before we get into the Banking with Life episode. We have a live event coming up in October 2023, downtown Fort Worth, Texas. I'm going to be speaking. Ryan Griggs will be speaking. This will be the second event that we've held. We did one last year in October as well. We're going to have some unnamed special guests. And Mr. Griggs, why aren't we naming the special guest?
Oh, it's a private event for clients only, and these are people who they don't need their names blasted around the internet, but our people need to hear from them.
Listen, the industry. When I say industry, when it comes to the infinite banking concept, becoming your own banker, these individuals understand the infinite banking concept. One is at the helm of a large life insurance company who understands banking. Okay, and then the other is. You'll be surprised who they are. I'm just telling you. And you won't find these two individuals in a room talking anywhere across the country under any general circumstances. So they're really not to be missed, in my opinion. Yep. There'll be a continental breakfast, lunch, an after party, and a room full of people who practice the infinite banking concept that are actually doing this and have been doing this. These are not all new people that first time they've ever had exposure. No, these are practitioners with a little P that are actually doing it, and you'll have the opportunity to meet them. I don't know where else you can go in the country and meet a room full of people who are practicing the infinite banking concept.
Yeah, not in this way. Neither do I. October 21st. 8:30 in the morning to 5 p.m. downtown Fort Worth, clients only. You'll receive an email from one of our offices with information and a link to purchase a ticket. Approved guests are welcome. Further information on the website. Again, October 21st, 2023. See you there.
Be there. In this episode, Ryan and I discuss premium deposit funds, highlights of a recent article of his on the subject, and then we tie it all up with financial marketing. We had fun and hope you enjoy listening. Welcome to the Banking with Life podcast. I'm your host, James Neathery.
I'm your co-host, Ryan Griggs.
And we've already been having a lot of fun here, shooting some promos for the live event that's coming up in October 2023, Saturday the 21st, 8:30 to 5. It's an event that you should not miss. So look for the promos. You'll get all the details. Look for the emails. And if you're a client, you should be receiving the emails either from my office or Mr. Griggs' office. All right, Griggs, Mr. Griggs, what have you got on your agenda? You have such a long drive, a new homeowner here, might I say, who moved about 10 or 15 minutes further away. So the drive got longer. So you have more time to think about what you want to talk about once you get here.
Yes. Not that I needed it, but I wrote an article recently, about 7,100 words. I should pretty much stop doing this. It should have been a book chapter, but that's okay. On premium deposit funds. I have a case going in underwriting right now. Individual who happened to sell a business, large chunk of change from the sale of that business, wants to become his own banker, wants to use some of, not all of the proceeds from the sale of that business to help start the infinite banking concept. And in this particular case, for all sorts of reasons we can get into, what's called a premium deposit fund writer or a PDF writer was a really good fit. So application submitted, going through underwriting, and I had, of course, built the case out. I see how it illustrates, see the effect, and it's like reflecting on just the mechanics, one-time payment, and then all these results that come, and I wonder if other people know much about this. So, and of course, I don't expect them, not from an infinite banking perspective, but I just thought maybe that there would be something from the companies.
Just about PDFs in general.
About a PDF writer in general. So I do a pretty thorough Google online search and can't find anything. Yeah. I think I found a blog from maybe a financial attorney where the word was mentioned, but there was nothing substantive. And I thought, well, that's a shame. So I went and wrote this whole essay, 7,100 words. Medium says it's a 28-minute read. I know it's not short, clippy.
I'm a slow reader. It didn't take me 28 minutes to read it.
Oh, perfect.
So
maybe other medium readers are slow.
I doubt it.
But yeah, so that, I don't know. I hope that has, and if there's an example, oh my God, I know everybody will show me the numbers, right? Need examples. So there's some bar charts in there that show the effect over time on an annual basis of cash value growth relative to premium. And, I'm interested to know when and if recently you've used these on a case. I don't use them a lot. And I explain in the article, I think, why that is. I make my clients aware of what they are in the process, but there's not much, there isn't anything out there to tell people about it before getting into an advisory process. And so the use case for them is we just don't know about it, or people don't talk about it. No. And then we also don't have my view is the framework one would need to understand, even the vocabulary in order to justify the use case isn't there either. Right. So this, I think, generally speaking, there could be other cases, but generally speaking, a premium deposit fund can be a good solution where we want to move a large chunk of change. That could be a windfall. It could be inheritance. It could be the proceeds from the sale of a business or property or accumulated savings that you built up over 20 years, right? You have a large chunk of change, what I'll refer broadly to as accumulated financial value or accumulated financial resources, and you want to utilize that to implement the infinite banking concept and become your own banker. And in particular, acquire a policy or policies, do more than one, in a non-MEC fashion, right? And so the industry, and then there's background in there, right? The industry has their sort of narrative, conventional view of what a PDF is and what the use case would be. And then there's the IBC, capital, cash value oriented rationale for why one would use it. So we can get into what a PDF is if you want to, but
we can, and that really could be a whole episode on its own. And I think number one, first off, let me say that it's a very well written article, and I'm appreciative. I've already sent like 5 people there. I'm like, are you friends with Ryan, or just go to the Facebook? That's where I seen it. Go to his Medium blog, and so it is well written, and I was, kind of grimacing a little.
I know. With
the charts.
Too transparent.
Huh?
That's too transparent.
No. Which
about design and.
Well, the reason is, number one. Well, no, people have a tendency to read a good article like that, and there's a lot of background information in it. It's a very good article, just beyond the PDF and the charts, right? Which I'm not opposed to charts. I'm a visual learner. I'm audible, kinesthetic, visual. It was a great article, good charts, but then you get into some specifics, right? The case, the structure, and then the chart keeps going, which is fine. But where I grimace is because people read things like that, and it's like, oh, well, this is the way I do it. This is what I should do. That was a very hyper-specific case, which also informs that not every case is the same. If you take the time to do a hyper-specific solution for an individual, and it happens to use PDF or whatever it happens to use, and that was the best solution for them, right? That is not to say that every case should use a PDF. And then there are various PDFs. There's no information in general in the big wide world about PDFs. So I think you have a couple of more articles in front of you. Talk about a chapter of a book or an addendum to your book, or maybe part of the next 2 or 3 books that you're going to write, because that should be fleshed out. There's so much there. So I thought it was a great article, and I've talked about it. And, historically, in my experience back in the day, most of the companies, the life insurance companies have a premium deposit fund. They don't want the policy to lapse. So here, put the money here before you spend it to pay a future premium or whatever their rationale is.
Yeah.
Right. But they're all very specific and they're all very different. The particular company that you reference has 2 different types of PDFs. Right. And then another company may have 2 different PDFs or 1 PDF, and they all function a little bit differently.
Yeah.
And you really got into the detail of the discounted interest equivalent.
Yeah, compounded interest equivalent.
Yeah,
discount.
compounded.
Yeah.
There you go.
So let me back up. So a premium deposit fund, for those who don't know, is the way I describe it is as a way station or a staging ground for future premium. Right, this is a separate fund, right? It's a premium deposit fund, so it's not an account. There's a tendency to describe it that way. You call it what you want. It's a separate fund in the form of a rider on a policy into which one can pay some year's worth of future premium, right? So it's a staging ground for future premium. You send the company money, they hold on to it. The company, a mutual life insurance company, which if you're working with the kind that we talk about, right, been around for a long time, strong, consecutive, 100+ year dividend payment history, right? So the value of the fund, your principal, is guaranteed by the company. So it's a very safe allocation. And then there's some financial benefit that companies apply, that they offer, if you were to use a premium deposit fund, right? Okay, so I put some money in the premium deposit fund. It's going to pay a scheduled premium in the future at a future policy date, and I get a benefit for that, right? The particular case that I discuss in the Medium article, the particular mechanism of financial benefit is a compounded interest equivalent discount. I know, bunch of words. It basically means that $1 of premium deposit fund money will pay more than $1 of scheduled premium in the future. Right? And there's a certain percentage. Let's say in this particular case, it happens to be 5%. So $1 of premium deposit fund money will pay $1.05 of premium in the future. That 5-cent margin is treated as interest, hence interest equivalent, but it isn't technically interest, right? The value of the fund doesn't change. It's just that when the money comes out to pay premium, it does so in a discounted fashion. It buys more premium, pays more premium than must come out of the fund. That margin is treated as interest for income tax purposes. So we're not getting around Uncle Sam here, right? There's going to be interest declared. You're going to get a form from the company that tells you how much premium got paid that didn't come out of the fund that's attributable to the discount. So it's treated as interest and it's compounded, right? So in year 2 or at the beginning of policy year 3, when it comes time for the second round of money to come out of the PDF to pay scheduled premium, $1 of those PDF funds, $1 of that PDF money will pay more than $1.05. It's as if the amount that comes out of the premium deposit fund has grown at what would have been 5% interest compounded annually, right, for 2 years. So it's the magnitude of the discount, the effect of the discount compounds over time. Hence, compounded interest equivalent discount. That's the way this particular premium deposit fund works. But in talking to you, because there's all these other companies and you've been around a couple more years than I have, and
always trying to beat me up on my age.
I got to take what I can get here. Other companies.
Notice I don't beat him up on his age, right? And 60 is the new 40, so I'm enjoying life.
85. No, I'm kidding.
Okay, have fun.
So other companies have premium deposit funds, and there's a dividend allocation called hold at interest, where you can tell the company, look, don't send the dividend to me, don't put the dividend back into the policy as PUA. Instead, put the dividend in a separate account where it will generate taxable interest. Hence, a dividend election, hold at interest. And to my mind, I'm like, that would be like a simple way to do a premium deposit fund, right? Just put some money in the separate account, treat it as interest bearing. The actual balance does grow. And in the future, it's a 1-for-1 when you take money from the PDF
I'm
to pay
out on
scheduled
that.
premium. Yeah.
But I mean, I get it. And hence the article, well written with the graphs. because it's not complex. It's very specific. I'd rather just pay a premium. And if I'm going to have money for a future premium, which I do, sitting in somebody's brick and mortar bank, I'd rather have it into the PDL.
That is a really great point, and it speaks to why I don't often use them. Like in my opinion, the rationale for and it's the same reason I don't like this overfunded structure. Right? You can't overfund something. There's a limit. You can't go over it. Right. Otherwise, it wouldn't be a limit. I mean, but there's these guys online who will talk about, pay $100,000 in year one and an actual premium. That's overfunding, and then in year 2 and beyond, pay $5,000 or $10,000, right? Very low. The idea of a big one-time payment and very little thereafter, I don't like it either. But I totally agree that it would be better to pay actual premium in the current policy year than to set aside money to pay premium in the future. Because between now and then, ostensibly, there's going to be other incoming cash flow. That money too needs a place to go. It needs to be used as premium. And so you're essentially underbuilding, right? If you have a structure where...
or overbuilding, as you mentioned a minute ago. Oh, pay $100,000.
The overfunding thing. Yeah. So I agree. So I think the use case for a premium deposit fund is quite narrow. It's really like this situation, but again, narrow, but legitimate. There can be cases
absolutely. Maybe I don't want to. Maybe I don't even want to as an example, just in personal planning or financial planning, retirement planning, whatever. Maybe I don't want to deal with future premium payments. I have it. I want it gone.
Yeah.
And so the guru says, well, put it in the market, or, well, put it into an annuity, one and done, set it and forget it kind of a thing. That, as an alternative, is tough to beat, in my opinion. Right. But if I'm practicing banking, and maybe that's not the only policy that I have, too, right? Maybe that I've received a lump sum of money and I do the premium deposit fund. Maybe I don't, but maybe I'm paying premium elsewhere. I want every dollar that I can wrap my mind around being exposed to the dividend. I appreciate the compounded discount, interest rate equivalent, because I thought that was you coming up with that terminology to convey what is happening is outstanding. I mean, because you didn't just wake up one morning and write that article, although he can bust out an article in like 20 seconds flat, no question. You dug into that, right? Yeah. And the terminology, I've never read that terminology anywhere. So that was outstanding terminology that you won't find in a contract or in the rider. But that is more accurate than, you just get a 5% interest rate. Yeah. And so that triggers a certain thinking. I'm going to get a 5% interest rate. Okay, well, the banks are paying 4.5 now, right? Why would I do that?
Exactly. I can do math. Yeah, bigger number.
Right, and if in the premium deposit funds go over various years, there's different rules for each premium deposit fund between the companies, and they're all different. So I'm just telling you, it's a very good article. It was a very good article. Like I said, I've referred a lot of people to it. The creating that kind of language to convey what's going on is very hyper specific, but well worth wrapping your mind around. And I think there's other work to be added to that on the premium deposit fund. And then if you're going to use cases, there's various examples. And I'm bringing that up, reiterating what I said, because I'm telling you, you're going to melt down your Medium blog now, because people are going to go, and you should go and listen to it. Half of them will be agents to figure out how to spell PDF. I digress. I love you, agents. I'm not talking about you if you're consistently listening to learn. I'm talking about the other guys that are, I'm being positive. Okay. The production board, right? That, we're all busy. We all have a lot to do, but that's another work that I think should be continued and expanded upon. And then I want to tie that into, I have a production board as well, AV modules and examples and case studies. And one of them is going to be specifically on the high PUA, not necessarily the high PUA in the first year, that I'm talking about right now, but I had a conversation a couple of weeks ago, and I'm going to round this out with a point on the production board. This is on my production board. That should be on your production board because it doesn't exist anywhere, right? And on my production board, this guy calls out of the blue, emails, and he says, "Oh, James, I've done this and this. I found you, and everything or a lot of things that you talk about is exactly what I've done, and I see that I want to do something different," right? And I'm specifically talking in his case about a 90-10 design. So in his particular case, a lot of things has changed, not for the good, but because of what he did, he's now in a position that he very limited on how he can correct it.
Yeah,
right. Wow. But you go through what you can do and the minor adjustments that you can make as a policy owner on a 90-10 jank policy, you should be aware of. So you can go or consider making those adjustments to better yourself and better your heirs. Right. Okay. Production board. Get it on your production board.
Yes, sir. But part of what led to wanting to do that was a conversation you and I had. You had a different case. I won't go too far into detail, but that's kind of goes outside of just IBC per se. But it was the idea that the regulation and the compliance and the paperwork around annuity sales is just extreme. And I mean, and it occurs to me too, like there's a huge annuity market out there. And the way annuities are treated from a tax perspective is what we deliberately, intentionally all day try to avoid in IBC. Yeah. Like modified endowment contract tax status is essentially the same as what the tax status is always on annuities, right? And then, there's a death benefit, and I mentioned some of this in the article. There's in most cases, but not all in annuities, there's a death benefit. But really, and it's not a death benefit. It's really just an account balance that transfers to a beneficiary. So it's a 1-for-1 type thing. If there's money left over when the annuitant passes, it goes to somebody. Occasionally, there can be just straight life where once you go, there is no more. There's no value to transfer.
And that right there, that's the basic understanding of the all-American individual. They don't talk about annuities until they get close to retirement. Then everybody wants to sell them an annuity. And I think there's a place for annuities. I'm not bashing annuities, but most people, that's their understanding. Mm-hmm. I put money in, I'm going to take a monthly income, and when I die, it's all gone. And there are annuities like that, but they're used for very specific cases. Yeah. Right. Yeah. But then too, like all the variable annuities, I put 100,000 in, the market went down. Now it's only worth 50, but if I die, it's going to pay out 100 because you're paying a premium for a death benefit. So you can buy the death benefit on some, annuities, but And then you just going down that road beyond the regulation, the word annuity, what does that even mean? Is it a contract? Is it, an equal periodic payment? There's a lot of nuance in the language of annuities. And then when you get into the financial world, it's so polarized. It's kind of like life insurance or infinite banking or term and permanent or investments against, annuities. It's so polarized. The guy who sells annuities, and that's what he does, he loves them. The guy who sells life insurance, whatever, estate planning or whatever, he loves them. The guy in the market loves them. Okay, perfect. I'm a loving guy too, but to exclude something, right, like annuity, because there's not clarity around the language or even the mechanics of it, is not good. It's the same as excluding dividend paying whole life structured correctly, excluding that. I mean, I don't know if you talked about it on your Medium blog or we discussed it, but you go to a restaurant somewhere and the financial guru over there next to you just starts screaming about how whole life, you dummy, you never use whole life or anything. I'm glad you're passionate in your ignorance. That's great. But, don't contaminate other people.
Yeah. No, I want to get to that in a moment, but to round out the annuity
I'm
thing,
queuing you up, sir.
No, it's good. I mean, and I think the idea of a contractually guaranteed income at some point in time is often a tremendous improvement over depending upon something that's market correlated.
No question.
That's fine. You know, I'm not bashing annuities for the sake of it either. It's just that the tax status is inferior and there's no loan provision.
Right. Well, and let me continue on that. In the financial world, not only do they love whatever they promote or what have you, they don't want to learn about life insurance if you're an annuity producer. You don't want to learn about life. You don't want to have your clients go through underwriting. You know, I send premium, that's what it would be called. Anytime you send money to a life insurance company, whether it's a life insurance or an annuity, it's premium or a loan repayment in the case of infinite banking. Okay, so you send the premium to the life insurance company with the annuity, and it goes through suitability, right? Which is not onerous, right? It's egregious in and of itself, but it's nothing like underwriting for life insurance, you know, where you can go through suitability with an annuity in a week or 2 weeks. Life insurance, it may take 6 or 8 weeks, right? And the annuity salesman, he needs to get paid now. He already spent the money.
Other way around.
What?
Suitability with insurance is often more streamlined than it is with annuities.
Yeah, but then I'm talking about the health underwriting with life insurance.
Okay, I see what you mean.
Oh yeah, no, the suitability with life insurance it's getting, you know, I have my own opinions of that.
Yeah. The mantra in, as far as I can tell, in conventional finance is that, you know, annuities are evil because they're illiquid. And if you start one and want to quit, there's a big old surrender charge and you're going to fleece the consumer. Right? And so the whole regulatory perspective is to examine whether or not you, stupid client, you know, have enough liquidity to properly, wisely buy this annuity.
Yeah, and the insurance agent got a great big commission taking advantage of the little old gray-haired ladies.
Yeah, you know, you can pour all your money into an over-leveraged market correlated account that you want, right?
Online in 20 minutes, tops.
We don't have to check your intelligence for that, but if you want to buy an annuity, then we got to make sure you go through this liquidity examination, essentially, interrogation, inquisition. We could go on, but
inquisition,
pretty accurate. But I mean, major thing from like an infinite banking type perspective, but just the idea of being able to take cash flow without interrupting the ongoing growth. If we suppose that there is ongoing growth in the underlying asset value, that's a huge deal, right? No loan provision on an annuity, period. But there isn't. And not bashing annuities, but I think you compare to like properly built IBC style whole life, potentially with a PDF writer, that's going to be hard to beat. And in this guy's case, you know, age, and I, you know, fudge the numbers a bit for. I don't want to put all of his stuff out there on blast, but approximately age 50, you know, had the business he sold happens to be a trades business. It was about $2 million that went to the company to both pay the first year premium and the rest would go into a premium deposit fund. And so it's going to pay the annual premium for 10 years. In this case, right, all of this can be changed. This is just one example. But the result was that about, I think it was $467,000 over the 10-year period.
$467,000. We're not talking about chump change.
Right. Basically, almost 25%.
What was the original premium? Sorry.
The initial inflow was $2 million.
$2 million. Yeah. Okay. $2 million. 400 that's a lot of money.
Well, and I'm saying over the 10-year period, 467,000 or so of premium got paid that he didn't put in the fund. Right. So 2.46 million or whatever in premium got paid over a 10-year period. Keep going down.
I thought it was 469, but I might have misread.
He only put in $2 million up front. So that was the effect of this compounded discount. I mean, that's a lot of premium, almost $500,000 in premium that got paid because of this discount that he didn't put there. And then if you think, okay, well, and I dedicate a pretty big part of the essay or article to this, it's like, what else would you do with a big windfall from the sale of a business? You know, I was telling you earlier about this friend I met, internet entrepreneur guy, builds online social media platform, sells off basically the subscriber or the marketing base to some other company, and they pay astonishing amounts of money for it. It's like, what else would somebody do with that big chunk of change like that? What do you do? You know, and there's a whole, that segment of the market is just not served, right? They're hounded by the brokers and the people who want to who want your capital under their management, right? But to secure a substantial windfall, and again, sale of the business, but inheritance, sale of whatever, what should one do with it? And so I kind of make the case that, going back to the distinction between capitalization and investment, you should start capitalizing. That should serve as seed funding for your own personal monetary system. And there absolutely is a challenge in designing that policy to accept that large amount, potentially in the form of a PDF, while also accounting for the likelihood that you're going to have other cash flow in the future, and it needs to be paid in premium too. Yeah. All right. So how do you square both of those, right? So in this particular case, the initial $2 million is going to cover the first 10 years worth of premium, but the policy is designed such that once that initial PDF rider balance is exhausted, he can keep paying premium.
It could be designed. Yours was designed that way.
Right. Yeah, I'm certainly not saying it's always going to be this way, but the way,
and I'm pointing that out because all these companies have quote unquote 10-pay policies. They're 10-pay. You cannot pay a premium in the 11th year, so it's really uber easy for the agent, not any particular agent, but an agent to say, oh well, you got $2 million. We'll just put it in a 10-pay, so it's one and done, right?
Right.
$2 million into the premium deposit fund, paid out over 10 years, and it's a 10-year pay policy. It's really easy.
Have the company build it, sign here.
Yeah. So I'm just pointing that out where it just speaks to the individual details of a case, every case. And I know your case is different than mine. I suffer from my case is different. I'm just saying your circumstances we're all different. And thank God, right? To take the time to design a plan that meets their needs, their goals, their desires, their check boxes. What are they doing now? What are they going to do in the future? What can they control, right? Because look, maybe a 10-pay policy is great for someone, right? Sure. Maybe it is. Nelson bought them. You didn't have the unstructured PUA when he was buying them, and then when he. I don't continue there, but there could be a place for 10-pay, but not if you're 39 years old and your income's going up. You don't want to pay a premium at age 59 or 49 if you're a 39-year-old. Right. That's crazy. So that's a very nuanced point.
It's the difference between obligation and option, or obligation and right, or authority or capacity, right? And this was a sticking point with my client's wife, and we did either group or three-way calls if they were in different locations all throughout. And, big chunk of change, worked hard on this business, selling the business, big life event, again, in their early 50s. So this is a seminal moment. And, as is often the case, one of two spouses may be driving the conversation, more interested, reading more, listening more, this kind of stuff. And so in this case, the client, whose name I'll refer to as Dave was, the one very enthusiastic about IBC and, wanting to help his wife understand more and more what we were doing. And so there was some initial skepticism from her about this idea of the potential for premiums to be paid after the exhaustion of the PDF rider.
She may not want to pay them.
Yeah. So the idea, okay, $2 million is going to cover, it's the idea that I don't want to do anything beyond that, or be required to do anything beyond that, or be committing myself to do anything beyond that. And so I showed them that to essentially illustrate this difference between capacity and obligation. It's like, no, I want to build out a structure so that if you want to, if you're willing and able to continue to pay premium, and kind of think you will be, but setting that aside, if you're willing and able to, then you have the right to continue. I don't
think you covered that in the article, but when I was referring earlier, you covered a lot of foundational, fundamental things in there broadly beyond just the PDF fund.
Yeah, a lot of things get baked in. It's hard to...
So, and I know I speak very broadly, but I've heard you say before, well, the canvas is big, so...
Paint with a broad brush, yeah.
The future is unknown.
Yeah.
Who wants to make a commitment that they can't fulfill? I'm sure there's some out there. I'm not. My clients are not. Your clients are not.
No.
You don't want to make a commitment that you can't fulfill. You don't know that you can fulfill it. So if the future is unknown, and it is, you don't know. He doesn't know. I don't know. No one knows what's going to happen, what their ability, desires, or their position in the financially is going to be in the 11th year. Mm-hmm. So if I have the right to pay a premium, and oh my gosh, look at the action of the policy on the 11th premium, and I'm not isolating that out where that's the only year that any good action comes from a premium payment at all. I'm not saying that at all. If you just look at the action that occurs on the 11th year, I'm sure they'll want to pay a premium.
Yes. And that,
if they can, right?
And that is so poorly understood, right? The idea that we say it and it sounds glib, or maybe it sounds cliche, or something about it maybe doesn't penetrate, but the longer you go out in the life cycle of a properly designed policy, the easier and easier those premium payments become. Like, it's why wouldn't you want to pay? And I was going to pull up the article and refer to this year 11 thing that we're mentioning. But in year 11, had he continued to pay the premium, which was the maximum payable was $246,667. So nearly $250,000 in total annual premium. And had he continued to pay it, it's a long article.
I thought I was a slower reader.
The increase in cash value in that year was well over what the annual maximum premium would have been. I think it was like a 1.4 factor. Like, if I have the right to pay premium of X dollars and have the result be an increase in the value of the asset, an increase in the cash value of 1.4x, it's like, why wouldn't I do that? If I had a asset right now that I could pay $100,000 in and watch the value, all of which I can get to by policy loan when I want, if I want to use for what I want, and the value of the asset was going to go up by $140,000, and I can do that every year for the next 20 years.
The factor goes up.
Then the number changes and the growth goes
every year.
Why wouldn't I do that, right? So the result here with the PDF is that the PDF essentially supports us through that initial illiquidity period. And it gets you to a point where now your out-of-pocket premiums in a certain year will have the offsetting effect, the simultaneous effect of cash value growth that's well in excess of the premium.
Well, he's probably not going to have any money. He's been so successful, built a successful business, had all the employees, had all the customers, and then he sells it for hopefully a beautiful profit, a substantial amount of money. This is just some of the proceeds, some of the net proceeds. So, yeah, he'll probably just be sitting on a beach somewhere, receiving mailbox money right in the 11th year. And I make fun of that because it is part of the short-term thinking that we all suffer from.
Yeah.
It's part of Parkinson's law. It's the thinking. Hence the big monstrosity first-year premiums. You're contorting the structure of a policy to make that happen. I get it. Nobody wants to be obligated in the future. Perfect. You can solve for that with a properly designed policy structure, right? Maybe I don't want to pay in the 11th year. Maybe I don't have the capital to pay a premium in the 11th year. Maybe there's not a lender on the face of the earth that would lend me money to pay a premium to see a 1.4 increase in the passage of time, 12 months. Right? Maybe after paying all of that premium to the life insurance company, I spent it all. I didn't even have enough reserves in cash value to collateralize for that premium. Right? And now, hear me, please. I am not talking about stacking, laddering policies. And, I want to bring that up because, I discovered TikTok, several months ago, but now it's stalking me. I think it's TikTok. It came up, a reel came up, a short video, a beautiful young lady, maybe 19, maybe 25, real quickly. Oh, you got to practice becoming your own banker. Let me show you how to do it with an IUL. And she mentions guarantees. Just the very verbiage that she's using is confirming that she does not know how IULs work beyond, however, she was trained by the IMO that she works for, right? Okay.
Was she even an agent? I mean, is a paid spokesperson doing a TikTok?
Who knows? On TikTok, are you kidding? Let's just go start a LLC and there's one licensed individual in there and everybody can share revenues and collaborate, right? But she also said, and I followed her, right? Because this is like gold, right? You don't even have to pay the loans back. Let me show you how the loan works. And then she's talking about just low loan interest rates that don't exist, have never existed, even in the lowest interest rate environment. And then, I mean, she just taking the buzzwords from the infinite banking footprint and applying it to universal life, and then adding in all of the marketing catchwords, phrases, these drive-by innuendos. But she's sincere.
Yeah.
I've
come to accept that there's a market for that.
Exactly. It's part and parcel of the thinking. The short-term thinking, it fits right in. The people that are attracted to that, right? That's attractive. Mm-hmm. There is a market. It's not going to go away, and it's going to exist, right? And whenever the agent says, hey, you don't have to pay the loan back, theoretically that works if nothing goes wrong.
Yeah.
Right. And that's still theoretical.
Yeah.
Right. Well, what are they going to do? I'm not going to repay the loan. I'm just going to, stick a life insurance policy in the middle of the cash flow. And I mean, that has come out of my mouth previously, but that can't be taken out of context. Right. What's the first thing they're going to do? Well, I got to pay $100,000 in your example in the first year. I don't have $100,000, but I had to borrow the $100,000 to get there anyway. I'm sure not going to have it in year two. I don't need the ability to pay that. And I'm going to collateralize every bit of it as soon as possible. Right. Oh, and then I'm going to go start an LLC and form a trust and get it complicated. So then you get the complexity, which, infers value. No. And then I'm going to collateralize it as fast as possible, as much as possible. The first thing they're going to do is not repay the loan. That'll be the second. They won't pay the $100,000 if they even had the contractual right to do that, because they could barely do it in the first year. They're sure not going to pay it in the second year and beyond. And I got to get to that crossover point where the total premium paid and the total accumulated cash value equal, because that's the only goal, right, of a policy. And the policy is just part of all of these revenue streams that you can go create. I mean, it gets so complicated, but it fits into the thinking. I'm not going to make a loan repayment. Okay, then you talk about the taxation of life insurance. If those things ever survive long enough to have a value above the basis, which I've seen lots of illustrations of, there are books that I will not use in my practice because this very thing that I'm speaking of proves itself. Right. And the example being, if the individual lived almost as long as Nelson Nash and you've got all these millions of dollars in outstanding loans because you never had to repay a loan. Right. And then it ends, the policy lapses before you died. Now it's not a life insurance policy, tax. Right. It's treated as a MET. Mm-hmm. $900,000 tax liability in that 1 year. Yeah. From all of the previous loans. All of that kind of thinking fits exactly into why the market exists.
Yes. And the contrast is that Dave, in this example in the essay, if he didn't want to pay anything past that 10th year, he doesn't have to.
Perfect.
He can shut down premium. And
you mean he has a contractual right not to pay a premium? He has that option, that ability, the financial ability not to pay a premium and still not be a MET and still probably take income, passive income.
$150,000 a year from age 70 to 90 is what it would have supported.
And how he's 50-ish. I don't want to know the details. And we're going out. That would put him at 60-ish. Yeah. And so what if he takes a vacation with this lovely wife, well-deserved, and, and after you've traveled the world a few times, it's like, my point here is most people want to be productive. He has been productive. He's not going to change the way he lives. So if he starts another business and sells it, then he can pay a premium if he wants to. After the vacation of 2 years or 3 or whatever, traveling the world, all of a sudden I'm bored. That sand's a different white from the previous sand. All the alcohol tastes the same. All the venues look the same. The food's about the same.
Yeah. Ooh, another airplane. Yeah. And the other thing is, it's not all or nothing. right? He could pay some of it. It's a capacity. He has use as much as you want.
So you're saying with all the money, all the capital in the premium deposit fund, he can say, hey, life insurance company, don't withdraw from that premium deposit fund.
Well, I can
pay a premium.
In this particular case, if there's money in the PDF, it's going to be that annual premium will be paid from it. But after the exhaustion of that PDF, when he's 10 years into the contract, entering year 11, he's got base, there's term rider premium, there's PUA. He could pay, we're talking about continuing to pay the maximum or pay nothing. Well, there's a in between, which is pay some. Pay some of the base and the term or some of the PUA. And I kind of list in one of the paragraphs all the different options that he's got. So many options. And there's such a range of flexibility and freedom that I think is foreign to people who have just been indoctrinated, not to no fault of their own, really, indoctrinated in this prior way of thinking where, we say, okay, well, the premium's going to be 10 grand a year. Okay, well, I've got to pay 10 grand a year forever. It's like, no, there's really so much more nuance. And so this, and I've had a couple calls with new clients this past week, who had interacted with other agents, and this is still happening. And part of me is sad for the industry. The other part of me is well, good, I can differentiate. But the blow up the inbox right away with the illustrations.
Yeah.
And you're not telling me that you've communicated the flexibility and the distinction between the right and the obligation to the policy owner.
Well, that assumes that they know or understand or even care.
Yeah.
Right?
Yeah.
And I'm sure. So I'm not trying to be any individual. I'm just generally the agent's mentality. They've been surrounded in noise their whole career.
Yeah. I mean, this kind of setup with the PDF, I'm looking out at it and I'm like, man, it's going to be so good.
Wait a minute.
If they just leave the money there, leave it alone, let it do its thing. And the other thing we haven't touched on is the liquidity. As that money goes from the PDF into the policy, that cash value is building. So it's not like, this was another one of the concerns was, are we locking up the $2 million? It's like, no, you're not. There's a rising liquidity there. The cash value is going up as premium comes from that PDF over into the cash value. You can collateralize the contract. Take a policy loan collateralized by the cash value. And as the years go by, as more premium goes in, cash value gets bigger. It grows more efficiently every year. It becomes more and more liquid the further you go out. And so, because one of his concerns was, what if there's an opportunity? I need to use this capital to go do something, right? Because that's a competing alternative too. I need to go invest, right? Capitalization versus investing. Well, this takes us back to the same principle that this is not mutually exclusive. We're capitalizing first, in fact, in order to invest better later. Right? We're starting a capital generation engine, building a place to put money. The revenue from the investments has to go somewhere. Might as well be to, your own asset that you own and control, the value of which is growing every year in a tax-deferred environment, accessible, tax-free. Why wouldn't it go there?
The investment has a revenue.
Yeah, big assumption. But hey,
I appreciate your positivity.
There's people who talk about all the thing, and the ratio of people who talk about getting into real estate to the ones who actually do it is a little heavy, a little one-sided. I'm going to get into real estate. Okay, all right. But then there's people who have actually done it. Right, I actually built the business, sold the business, and so and I see the numbers. The checks there, and so I'm willing to grant him a little more rope than I might otherwise. So and he's already started other types of enterprises, and that cash was going to have to go somewhere.
Yeah. Well, I think once because there is liquidity to the PDF, it has ramifications. Each one is different. Each PDF is different, but that's once you understand, see the numbers, understand the cash flows, the mechanics of the policy, the construct of the solution. The first year is the least amount of liquidity, is the most inefficient time period of a policy. And of course, if you're new, that's very intimidating. And it doesn't typically take long, 1 year, 6 months, 2 years. It's, oh my gosh. Of course, I didn't pay a big enough premium. I can pay more premium.
Yeah.
That illiquidity, the loss of liquidity is temporary, right? And once you understand the mechanics of a policy, you own one, the first annual statement comes in, the numbers. I mean, we can all read math and, see the numbers, but we're not accustomed to the accounting of a life insurance company on a life insurance policy. My point here is that loss of liquidity diminishes quickly, especially on an annual cash flow basis. And oh my gosh, if I can access the money that I understood that I can, and understand how a loan function, and I understand how I can control that, and it integrates with me personally and my cash flows or professionally, it's like in the second year you're looking around and it's like, how much can I pay?
Yeah.
Which the more you dig into life insurance, in my opinion, properly structured, mutual company, pays a dividend, it's you literally and physically can't pay enough premium. Wow, you got to get by you got to get by the space between your ears first, but once you get by that, then you've got to get by the underwriters and the suitability and, the National Association of Insurance Commissioners. How much can you have in force? How much can you pay in premium? What's the insurable interest? And how much, all of that, right, are challenges. Once you are vibing and you get it, you see it.
Yeah, all that comes after you say yes.
Right. I mean, your confidence level goes up, and oh my gosh, it's really, then you almost become skittish. You're like, well, am I paying too much, James? Should I really be thinking about it? Comes naturally when you should expand. It doesn't necessarily come naturally how to expand properly, right? Which, an educated agent and advisor would, kind of help through that thinking process. But it's just another attribute or characteristic or result from paying life insurance premium, understanding it, and then experiencing it, the confidence level goes up. It's like, oh my gosh, can I even get past the underwriter? Am I thinking right? And the answer is yes. If you have a need for capital, and you're going to have a need for capital, and you are, it's like, yeah. So how much is too much? Mm-hmm. All right. How much is too much? Well, and I've talked about the arbitrary numbers in retirement planning, financial planning. How about until I can't pay a premium. I don't have a cash flow dedicated to, or I can dedicate to being exposed to a dividend forever. Right. I just don't have it. I've been creative. I don't want to take on the leverage, whatever the case may be. Or the underwriter says no. Mm-hmm. All right. That's good enough for me. When the underwriter tells you, fat boy, you're too fat. Yeah.
Yeah. I'm excited for these folks. I mean, especially when you start looking at the late life passive cash flow picture. So start at age 50, I assume passive cash flow age 70 to 90. I mean, it's $150 grand. The policy would easily support.
Did you illustrate loans in that?
Premium and offset. So this was partial surrenders.
Okay.
Yeah. Just for the sake of it, again, sure. He has options. Take whatever he wants. But yeah, let's see, what was it? It was $150 grand over 20 years, $3 million. So you could take $3 million in late life distributions in total, all tax free, age 70 to 90. He only put in 2. Okay, so he got back 150% of what he paid in, and he had the use and control of all that cash value in between.
Well, that's not even in the article, what he does with that or not. He's already off to other businesses and other ventures.
Right.
Yeah.
Or there's the fact that there's a death benefit behind all that.
Oh, we didn't factor in the cost of the death benefit?
Oh, yeah. And then all the savings on interest that he'll enjoy by not having to rely on bankers for the business line of credit and the car loans and the next house or whatever.
Yeah. Oh, all that.
Where's that on the graph?
Approval, yeah.
Not on the graph.
Didn't have to take the risk of a market or whatever. He just has ample cash flow. How does that make you ample capital and cash flow? But how does that make you feel? How would you rather be undercapitalized and needing money and somebody else got to prove the access to that money? Or would you just rather have a big old pile of capital and it's like, yeah, I'll get to it whenever I see the appropriate opportunity and I won't ask anybody.
Yeah.
I mean, your blood pressure goes down, your cortisol levels go down. Yeah. I mean, there's so many. Oh, wait, it bypassed probate too? What? You didn't have to put all that and you didn't have to tangle that up with a trust? Wait, you didn't have to talk to a CPA?
I really want to pay my attorney, though. those legal
Yeah.
fees.
Well, it's complex. Right.
And that was just with the $2 million.
Yeah.
Do nothing else. Generate no cash flow over the intervening 10 years. Can't pay a premium in year 11.
Yeah. Then you just have to suffer the fools that you share it with and their opinions. But then, wait, no, but you're not making him dependent upon you, right? So I know you're going to, well, I believe you're going to be here in 10 years, God willing, and I believe he is, and you're able and you are. So does he understand well enough? I mean, my point here being is, he's not going to be dependent upon you. He's not going to be dependent upon the financial guru or a banker or whomever, right? You can actually encourage and lead the way and show through education and understanding and experience how to be independent. Mm-hmm. What's that word?
Yeah.
I mean, there's so much and the mere fact that, so his wife maybe, or spouse may be, a little bit hesitant. What are we going to do in year 11? Maybe he don't want to pay a premium in year 11. Okay, it's done. They've started and they see the cash values go up. They see that their liquidity is not compromised. They see the capital that they do have access to. Maybe I can enjoy that white sand beach a little more. I'm not worried about that.
Yeah. This is I know, don't use life insurance for retirement planning, dum-dum. This is a full late life passive cash flow plan. Okay, in a tax-free environment that's private property of the individual. And it's on a much firmer grounding in terms of predictability and expectations than is something that's market correlated.
I didn't publish
one
it.
payment at age 50.
Yeah. How many events in your life are you going to have $2 million coming in, or $4 million, or 100,000, or whatever it is? It's okay to do something correct with that. You did a Facebook post several weeks ago, because I wrote out a response, but I never sent it.
Yeah, you didn't post it. It's okay.
It's like that thinking, and I think you were talking about an investment guru at a place that you were at, and he was just talking loud and bashing things that he doesn't understand and whatever. Whole life insurance.
Out at dinner, and I hear, a few chairs over, the young guy dressed nice, whatever, talking to somebody else, and the other guy that was talking to the young one said, I'm over here selling you. I'm telling my buddies all about you. You gotta come tell him. He's got this cash value thing. I told him.
Talking to you?
No. This is the other individual talking to the young guy.
Okay, I got it.
And so that conversation, I'm listening to this conversation happen, and in response to that prompting, this financial guru, conventional advisor, comes out with the slogan, you shouldn't use life insurance for retirement planning. And it's always, the words are just like dripping. And this is the part that really irritates me. And I had to dial back some of my language in the post, because it gets me. I really don't like this. It's like rhetorical bullying. And it's like, I know your game. You're not being clever or cute because you can be condescending and paternalistic. I know exactly what time it is, but it's always dripping with this, you stupid moron, you shouldn't use life insurance for retirement. But those are different words. Life insurance should be life insurance, by which they mean death benefit. And retirement, you should use retirement vehicles for retirement planning. Those two are the same words. It's so condescending. And yet at the same time totally obfuscating, right? So it's like, you dumb idiot, but don't let me tell you anything about why what I'm implying is true. Right? You should just accept it, rube. Yeah, absolutely. It's so, but then people take it because they feel like they don't know enough about finance. This person's an expert. He's saying it confidently. It's got this intonation. He's got nice hair. He's wearing and then we just accept it as everybody else is doing it.
Everybody knows it, but me, I'm the guy who doesn't know that you don't use it.
I feel dumb. Yeah, maybe maybe this person is revealing this simple truth that's just never been put to me like this before. Is what the vibe is.
Sure.
And it's like, I'm like, can I get the check, please? Get me.
You couldn't get out of there fast enough
because he was looking over for other people to talk to,
support or beat up,
to
support him,
more potential clients.
That's how he attracts clients.
He's looking around for more, and I'm like, please don't start talking.
Yeah, he had to look up to you, didn't he?
Yeah.
Here, I'll just share what I wrote, but didn't send. This was going to be a response to that post. I would use the word discount but that would assume consideration was given to the banking function. Therefore, the glaring and fatal flaw, in my opinion, in financial planning is not discounting the banking function. It's a complete lack of knowledge that one can actually control the banking function as it relates to them and profit from doing so, especially over one's lifetime. So the flaw, right, the lack of knowledge, coupled with a hyper focus on a single characteristic or component or relationship between numbers of a financial product, like life insurance, what the premium you pay, what's the relationship to the death benefit, or what's the dividend, the hyper focus on a single component of life insurance, right? This seems to me to be the solid bedrock in which these types of sound bites and cliches firmly rest. I believe that. And then you add ego, ignorance, and arrogance that exists in the average financial professional. You add that with the mix of the lack of knowledge, the understanding that you can actually can control the banking function. You put all those together, and then we have all the required ingredients to build and maintain and perpetuate a disappointing financial struggle for yourself and your future prodigy. So the front is broad, and job security is solid, because all you're doing is pushing back the frontiers of ignorance or expanding the frontiers of knowledge. And that attitude, those words, sound bites, cliches that everybody hears over and over through all the media, through print, radio, TV, all the quote unquote financial salespeople that are unlicensed and unregulated. And I'm not for regulation, I promise. That's how they get by. Everybody knows it, but whole life is bad. It's terrible. Yeah. The agent gets paid a big old commission. The life insurance company, that evil entity, keeps all of the cash value when you die. And they're charging you interest to borrow. Every statement there is wrought with ignorance. But it sounds good enough. With confidence and arrogance, it could come across as, he obviously knows what he's talking to. And it's like, yeah, maybe a health insurance claim didn't get paid. Maybe an automobile insurance claim didn't get paid. So all of the insurance companies are bad.
Yeah.
Yeah. You got to have the ignorance, and you got to have the arrogance, and you got to have the bravado, right? And you got to have... It's heavy on the ignorance for that to work. And then what have you done? You're dependent upon the financial markets, whatever they are. You're dependent upon the interest rates. You're dependent upon the third-party banker. Every one of those entities that control those functions are getting wealthy. Every one of them at your expense. And then teach your children to do the same thing.
Yeah.
And your grandchildren to do the same thing. Yeah, it's perfect. Yeah, I can't think of a better solution.
I think a lot of it has to do with an unwillingness to dig deep and come to a firm, decisive view about what's right and what's wrong in the business. There's this attitude that anything goes, the consumer's always right, whatever they want is correct. I'm just here to serve. It's this kind of innocent,
I'm collaborating,
performative naivete, right? Where it's like, I'm just here to be helpful. It's like, okay, it's kind of deceptive, half true, compassionate narcissism. I
don't think that was his attitude, was it?
This kid that I think very much so. I think yeah, and it's a convenient route to take, right?
Absolutely.
Like everything is fairy dust and unicorns. I want to be helpful. My heart's in the right place. I can do well helping you. Everybody's better off. I've got these compliance approved, HR approved slogans and marketing materials to support what it is I've been told to tell you to say, and everybody's going to be better for it. It's all packaged. There's a bow on it. And the good intentions are there. I mean, I really do assume angelic intention. I'm sure he's a nice kid. And we probably have good conversations talking about anything other than money, right? But the problem is that doesn't have anything to do with whether or not the underlying proposals are proper and correct or well suited or not. And that's what irritates me. And when you go back and you add even more of the pomp and circumstance, the smoke and mirrors, the click funnels, the online marketing stuff, it's just like now you're making it worse. And I like in that Facebook post you mentioned, it's no coincidence that the only textbook published by the Board of Certified Financial Planners is on the psychology of sales. Yep. Not economics, not financial theory, not history of thought, not anything substantive. No. The psychology of sales. How to talk to somebody to get them to say yes or to get them to change their mind when they want to take money out in a down market. Right? The Board of Certified Financial Planners, the allegedly top designation in the financial planning industry, is primarily interested in psychologizing to get you to say yes. If that's not a problem, what would be worse, right? It's like the board, the bar, the state bar and attorney bar, like specializing in teaching attorneys like how to manipulate clients rather than how to argue legal cases, or doctors, imagine a medical board publishing textbooks telling the doctors how to tell their patients to just say yes to the medication rather than to treat the underlying illness.
They don't do that.
And but in finance, not only is that what they do, it's like they're proud of it. Like, join our organization so you can do webinars and live trainings and get our textbook and get discount to go study the psychology of sales. That is, if you spend a little bit of fraction of time thinking about it, it's very difficult for me not to end up at, well, that's kind of morally reprehensible. Like, so you're professionally a part of an organization, the purpose of which is to help people say yes for the sake of it, right? Not because there's this underlying compelling economic or financial theory. That's just a sideline, a sidebar provided in the addendum or whatever, the special marketing material. It's all about getting you to say yes. That is get away from me.
I'm going to keep my mouth shut.
Anyway.
All right. That was fun. Yeah. So anything else?
That's been what's on my, come to the live event, October 21st. Oh, for clients. If you're a client, come to the event.
Well, there's a couple of months there. You have an opportunity if you're not a client.
Yeah.
Whatever. That's my click funnel.
Enough time for
there's a tripwire somewhere hidden in there, and and the paywall, and what do you call that? Whenever the tripwire just gets them going, and then there's a small purchase, and then a little bit larger purchase until you find the big Kahuna, the $29,000 sale that we'll discount today only for $9,000 or $10,000, and we'll finance it. What do you call that?
I have no idea.
Marketing.
I'm sure there's a thing. Yeah.
Okay. I really did have fun. So
me too.
Thanks for listening.
Bye, y'all.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.